So banks now are telling you, I don't have it. Banks are now telling individuals that pre-approval that I gave you 6 months ago, a year ago, it's worthless now.
Wait, what?
We can't use that. We're gonna have to basically re-underwrite you again.
Whoa, 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 whoa.
And, I hate to say I told you so, but we knew this, guys. We knew this was gonna happen, and it's here today. Before we jump into it, my name is Orlando. Welcome to the channel, guys. Make sure you hit that like and subscribe button. Also, check in the description and in the pinned comment. I have a newsletter of things I talk about that are not on this channel or on these videos, guys. I promise you, you will love it. And on top of that, it's free. How can you pass up free? Mortgage credit availability shrinks to a decade low. How is it possible that we can, predict the future and kind of see exactly where this is going? Only if we had, history or something to tell us that this exact thing has happened before. Guys, and this is my thing. A lot of you guys are saying, Orlando, you called it. I mean, if we just read the patterns, we know what's gonna happen. We know where the red flags are going. We know how this cycle goes, guys. We've seen this movie before, guys. We've seen it. It's a rerun. Let's jump into it. It says, as if higher mortgage rates weren't enough, it was harder to even qualify for a mortgage in July than it had been in a decade, according to the Mortgage Bankers Association. Its monthly index measuring credit availability dropped in July to its lowest level since 2013, indicating that lending standards are tightening even further. Let's repeat that. I need everyone to hear this. Indicating that lending standards are tightening even further. But if you listen to a lot of guys, this is the best time to lend.
This is the best time to go get a mortgage. If you don't get a mortgage right now, if you don't go buy a house right now, then you're missing the easiest time to get money than you have ever had in your entire life. You may not see this time to purchase a home and get easy money than right now, guys.
That's what some of these guys are saying. I mean, based on the reports and what we're seeing here, that is as plain as day in data. And I don't know, a person who's actually in the industry is telling you right now, Orlando is telling you, it's getting hard out here, guys, to apply and to get approved for the mortgages that you want, even at a higher interest rate. Why is this, guys? Why is it that I knew that it was going to get harder and harder and harder? Well, it's because the cost of money is going up. And I know what you're thinking. You're thinking,
Orlando, that's crazy. Banks want to make more money in a time like this because they can charge higher interest rates.
And I would be like, you're correct. But the one thing you're missing is when you have higher payments and you're pushing people and wage growth hasn't happened, inflation is going crazy, and people are telling you, and you're seeing it in the data, that people are living paycheck to paycheck. It's getting harder for people to make it in this economy. And you're going to give people interest rates that are higher and higher and higher. Your risk goes up as a bank. The risk of default is going higher and higher and higher. And when that happens, banks will pull back and say, we only really want to lend to people who have a bunch of money. We don't want to really lend to people who are on the borderline. We have that low interest rate and we could give tons of money at volume, and we really don't have to worry about individuals not paying because the interest rates are so low, the economy is really good, unemployment is super low, then that's the perfect time for a bank to lend money. But right now, when things are so high, the risk goes up. And a lot of banks, believe it or not, want to have the lowest risk that they possibly can. They want risk so low that it's almost guaranteed. So these guys are pulling back. They're going to say, you got to provide X, Y, Z. We need to make sure that your job is stable. We need all of these things to be in line that we didn't. Here's the thing. We didn't require this 6 months to a year ago. We didn't require this stuff. But today we are. And I knew this was going to happen. I forewarned all of my subscribers and viewers that this type of thing was going to happen. That it's just a cycle that is going to happen. And if you thought that you could just sit on the sidelines without doing anything, without getting your credit together, without getting your liquidity together, and do nothing. Just
a house is gonna fall in my lap. They're just gonna email me. My realtor's gonna email me the perfect home, and it's gonna have a price cut. And yeah, I'm just gonna handle my year-old pre-approval, and we're good.
While availability for all loan types dropped, the component for an index for jumbo loans fell the most. As banks face increasing liquidity issues, jumbo loans cannot be sold to Fannie Mae and Freddie Mac, so they are usually held on by bank balance sheets. Now, let's just make this really simple that everybody can hear, because this is a lot of industry talk in there that a lot of my viewers and individuals may not understand. Well, what we're really going through right now is that the Fed is basically requiring a lot of banks to have a lot more liquidity than they previously had. So what does that mean? That means that they have to have a lot of money on hand. That if something was to happen, that they will be able to cover deposits and things of that nature. Well, banks do not want to put their liquidity at risk for risky loans. Does that make sense? If they're going to loan money, they're going to loan money to individuals that they know that they can get their money back, that have tons of collateral, that have great credit, that basically fit into a box of, do they really even need the money? Do they even really need me to give them the money? That's the box that a bank wants to lend to in this economy, in this situation. And with the Fed continuing to say to banks, we need you to have more money on hand than ever before, banks are like, my hands are tied.
The way my account is set up, I don't know, I can't do it.
But here's the secret, guys. Here's the secret. They would have done it even if the liquidity requirement wasn't as big as it is right now. I still believe banks would have said, yeah, this is a risky moment and we're going to bring down our box. Our credit box is going to get a lot smaller because we don't want to take the risk. Now, they do have a legitimate reason now that the liquidity has been pushed up for the banks to make that decision. But in my opinion, in my humble opinion, I think that they would have done it regardless. Higher mortgage rates have caused demand for home loans to drop. Mortgage applications to purchase a home are 26% lower than they were a year ago. And finance demand is off 32%. Guys, this is very normal. We expected this as demand continues to drop because interest rates are continuing to go higher and higher. Do we know what the Fed is going to do now? Inflation is to continue to still go up. We have unemployment is going up, which is what the Fed has wanted. But is it going up that much? Not in my opinion. And then we had the PCI numbers come up, and that was showing that inflation is going up a little bit higher than what they thought. So are we still going to have the Fed raise up interest rates? My guess would say yes. Yes, I still think, and I would hope that he's going to continue to still raise interest rates, because if he doesn't raise interest rates, we're going into this holiday season here. I believe that this is a tale that's going to right itself. If the Fed does not push up interest rates as we're going into the holiday season, I think that we're going to pay the cost dearly. I really do. I think he needs to keep his foot on the gas and continue to push down on inflation. If, let me put this caveat in, guys. If he really does want to get down to 2%. I mean, that's what he's saying. So if he wants to get down to 2%, then he needs to keep his foot on inflation's neck, right? And the tool that he has to do that is raising up interest rates. Now, I know some of you guys don't want to hear that because a lot of you guys want interest rates to come down so you can purchase a home. But I'm telling you, you're going to get low interest rates, but you're not going to get the price that you want. Let's focus on purchase price, not interest rate. Interest rate is a tool to get the price down.
Write that down.
Declining origination volumes have led to lower profitability for many lenders, and this is true. I've talked to a bunch of colleagues. Everybody is feeling it. Everybody is, there's a lot of mortgage origination places that are just going out of business, a lot of layoffs happening in the banking industry. And a lot of lenders are doing some ridiculous things to make up that money. I mean, I just did a video on Rocket Mortgage who did the 1% down payment. That's to bring in more business. I also did a Zillow video telling you the 1% down payment program that they're offering. That's to bring in more volume. I also did a video telling you guys about the HELOC credit card that's going around that is attaching to your home. That's to bring in more business. So you can see these wild and crazy things happening. And if this doesn't show you that there's a red flag going on right now, I don't know what is. When banks, guys, are starting to take on more risk, here's the thing, more risk than they normally don't want to do. This is crazy. I'm talking about how banks normally don't want to do risk. And in all of those things I've named, that is a bank taking more risk. Is that not a red flag? But here's the thing. In all of those scenarios, the benefit to the bank, even though it's higher risk, is heavily on them and more on you. You're more to default in a scenario like that than the bank is to lose out in a scenario like that. I mean, do I have to even talk any further when I say you're going to do a credit card with a HELOC on it? You have to know that you're not going to win that situation. But, you know, in that video, a lot of people, I've got some comments on that video where people told me, Orlando, this is a great deal. You don't know what you're talking about. I would do a HELOC credit card on my house any day. And listen, I can't help those people. I can't. If you think that's a great decision, by all means, go ahead and give your house away to the bank. Do what you have to do. But this is my thing. The red flags are out there, guys. We obviously see these banks are out here doing crazy, crazy things to bring in business. Regular, everyday mortgages that you want to get a fixed rate on, those are going down. It's getting harder and harder to qualify for those because of higher interest rates, stability in jobs, the way the economy's going, and the way that banks are underwriting individuals now. So, as I have always said, make sure that you sit on the sidelines with a purpose, guys. Get your credit together. Get that down payment together. Make sure you have an emergency savings account. Do all of those things and do the research on the homes that you want in your neighborhood to see these prices come down to an affordability level that you can afford. And as always, do not overpay. As always, I hope you got value out of this content, but you know you will not get all of your information from this one video. I need you to watch this video here. It will help you learn what's going on in the housing market, financial news, and get you in your first rental property. And as always, the information you will get from that video, it will be gold. See you in the next one. Thanks.